In this video, I'm going to share with you the 4 most common metrics used for multifamily real estate investing. If you're a passive real estate investor, these are probably going to be the top 4 metrics you're going to see from a general partner. So it's good to understand them. By the end of this video, you'll understand what these metrics are, their pros and their cons, and I'll also share with you a 5th quote metric that really sets real estate investing apart from all other asset classes. So stay tuned. I'm Dan Calonge, and I'm on a mission to help immigrant professionals grow their wealth passively through real estate. If you'd like a copy of my passive investing guide for immigrant professionals, click down below in the description. So these metrics are very common to use in real estate syndications. A real estate syndication, in case you don't know, is a method where you bring together you pool basically investment money from many different investors together to be able to purchase a large property as an investment. If you want to learn more about what real estate syndications are, I created a video that talks about it, and you can click on it right up here on the right hand side. So let's dive in now to each of these 4 metrics and find out how they work overall. So there are 2 primary ways that you make money through a real estate syndication. One is through cash flow, which is the monthly income that comes in from the property. And the other is through equity. And equity is sort of like in your home. For example, if you buy a home now and you sell in 10 years, it's going to be worth more. The delta is the equity. Those are the 2 big levers that you have when it comes to making money in multifamily real estate. The metrics help you put some numbers around these different levers, and so we're going to talk about those. So there are 4 metrics I'm going to talk about. First is cash on cash. Second is internal rate of return. Third is equity multiple. And finally, 4th is annual rate of return. So these 4 are the biggies that you see in most investments. Now let's start first with cash on cash return. So cash on cash is the actual cash received during a given year divided by the amount of investment that remains in that property that you've made. So in this example, amount received divided by amount invested gives you the cash on cash number. So let's look at an example. So let's say in a given year, you received $5,000 of income from an investment you made, and the investment was $50,000. So the cash on cash return is 10%. So it's pretty simple. That's really what that metric means. So here's an example. Let's assume you invested $100,000 into a real estate syndication. And over the first 6 years, it was bringing in this amount of money every year. So $4,000 came in year 1, $6,000 in year 2, etc. And let's say it was sold after year 6. So you've got 6 years worth of income. Now, with the $100,000 investment, if you look at that $4,000, $6,000, and $8,000, etc., the $4,000 is a 4% cash on cash. The $6,000 is a 6% cash on cash, etc. You can see it go across the way. So this cash flow pattern that you see here is actually quite common when it comes to value add properties. When you're investing in a value add property, typically a lot of money is spent in the first year or 2 trying to renovate the property and bring the values up. So the cash on cash is going to be lower, sometimes even 0 for the first year or 2. But then subsequent years after that, it grows a lot. And then the big, obviously, cash out is at the end. But cash on cash really talks about what's that income every single year. So if it's 4%, 6%, etc., that's great. A lot of people will at the end, they'll average it out. So let's say, what's the average annual income that came in? In this case, it was $9,000, a 9% cash on cash, which represents an average of the 6 years worth of cash on cash returns. So that's cash and cash at a high level. All right, so let's talk about what cash and cash does well. It shows you an annual return based on the money that you've invested. So it's very simple to understand. And it measures the relative risk. For example, you can see I mentioned the example of the value add versus a stabilized property will probably have very consistent cash on cash throughout every single year. But it does that pretty well. What it doesn't do well is it doesn't really capture the time value of money. So it doesn't really give you any sense of whether you got the money sooner or later. Really has no bearing, which is a weakness of cash on cash. But it's a very simple metric, which was why people like it. Typical targets of a cash on cash return, I typically see between anywhere from 5% to 13%. If there's higher than 13% is certainly possible, but I would recommend doing some more due diligence to make sure there's a sound plan behind that and backing for that number. And things to keep in mind, this is really, you want to look at the cash on cash, either it's average across the board, which is typically how it's reported. But if you ask to see the annual amounts, you'll see a little bit more of a detail as to how the money's being spent in the property, which will help you understand it better. As I mentioned, the value-added investments typically start out lower in their cash on cash, but they finish higher. If cash flow is your number one priority and you want to have a steady high cash flow, as high as you can throughout the entire 6 years, for example, then you'd probably want to look at a stabilized property that's not a value add. But if capital growth is the most important, if you want the biggest upside at the very end of the deal, then more than likely cash on cash won't be that important to you, because what you really want is that big upside with the equity at the end. So these are some thoughts about cash on cash and how to use it. Now let's talk about preferred return. A preferred return is paid out to investors, and they receive first priority from all operational profits that come off of that property. After investors get paid their preferred return, then the profit is split between the investors and the general partners or sponsors, according to the equity split. So, for example, if there's an 8% preferred return, then the first 8% of profit from that property every year goes directly to the limited partners, so the investors. And anything above that would be split. Now, it's done in a cumulative fashion too, at least how we do it. And the way that happens is if you, say, have a 6% cash on cash one year and you're short 2% of that preferred return, then that 2% gets added on the next year. So the next year, instead of 8, it'd be 10% preferred return. So this is a great way to make sure that the limited partner, the investor, you really get the maximum income from the investment that you're making. And I think it's a very fair and smart way to do it. Typical preferred returns that we see are anywhere from 5-6% to maybe 9-10%. And it really depends on a lot of things and the potential risk that you're getting into. So it's good to understand the property and the investment that's in front of you. Now let's talk about annual rate of return. So average annual return is pretty simple. You just calculate the return for each year of the investment. So say it was a 6-year hold, it was bought, held for 6 years, and then sold. You take the total profit made from that investment divided by the amount invested and divide that by the years invested to equal the annual rate of return. So just as an example here, if you had $95,000 of profit at the end of the day and you invested $100,000, you divide that by 6 years and you'll have a 15.8 average rate of return, which gives you just a basic idea of what the return is across the board. So what it does well, it annualizes your returns across all the years, which is great, and allows you to more easily compare, say, for example, what you're getting in your stock market versus this. But again, one of the issues with this model is that annual rate of return doesn't consider timing, again, like we saw in cash on cash, which not necessarily bad, it's just something to know about. Typical ARRs that I see are between 15-25%, depending on the type of investment. And one thing to keep in mind is that because timing is important, this really is not the only way that you should be looking at a real estate investment, is just through this lens. That's why there's multiple metrics to be able to look at these holistically. Now let's talk about equity multiple. The equity multiple is pretty simple. It's just a numerical value that tells you how much you've multiplied your cash that you've invested. So It's the total amount of money you receive back at the end divided by the total investment you made in the beginning. So for example, let's say at the end of an investment, the property's been sold, you had put in initially $100,000 and you got back $165,000. That's a 1.65 equity multiple. And that's a very common metric that's out there, very easy to understand, and it's also very easy to get a grasp as to what kind of income you may see over the period that you're holding that property. So what does it do well? Well, it's very easy to use. It tells you how much money you'll get back after an investment. So that's pretty straightforward. Again, with this one, it doesn't take timing into account. So whether you get the money like in a year or in 6 years, really doesn't matter when it comes to this metric. So, it's got some cons, but it's something that is easy to understand, which is valuable. Typical targets of equity multiples, I've seen 1.5 to say 2.3. Above 2.3 is starting to get pretty high. And before getting so excited about, wow, this is a great deal, just look into the due diligence, understand a bit better about who you're working with to make sure that you understand the business metrics behind it. And things to consider, it can only be calculated after the property is sold. So you can't really know for sure until the entire 6 years, let's say, is up. And the longer the time period typically results in a higher equity multiple because there's more opportunity to increase that equity over a longer period of time. So some things to think about when it comes to equity multiple. Now let's talk about internal rate of return. The internal rate of return is kind of like the annualized return, except that it does consider all cash flows, either in or out. And the big thing is that it includes timing of your cash flows, which is a big deal. The thinking is $1 paid today to you is more valuable than $1 paid in 6 years. So there's a formula right there in the middle. You don't really need to memorize it because Excel does a great job of calculating it. But this is the gold standard of metrics because this really accounts for all those different inputs, outputs, and timing, which is huge. So what does it do well? It takes into account all cash flows and the timing, which is really key. And it's really good for comparing different alternatives in investing. It's really good for that. What it doesn't do well is it doesn't account for, say, details of the offering. For example, a 16% IRR is not necessarily better than a 14% IRR if there's higher risk involved in that 16% IRR that makes it unattractive. Typical targets that I see in multifamily real estate are anywhere between 14 and 20%. Above 20%, I'd say just really take a close look at it and make sure that you're really understanding what's going on, because that is a unusually high IRR that's not often seen. But it is possible. I've heard of it, but I just haven't seen it too often. Some things to keep in mind, shorter time frames produce higher IRRs. Why is that? Because it's the time value of money, right? The less years you have to account for, the closer to today that money is, so it's worth more. Again, IRR is not the be-all, end-all. It's you need to get familiar with the risks and all the things that are being discussed and the strategies that are being shared on that investment. So, which return metric is right for you? This is a really tough question. But the right answer here is it's really best to look at more than one metric. No single metric is best. None of these four on their own can do a sufficiently good job of telling you what's going on. And depending on your goals, a higher metric might not be necessarily better. So if we look at what's important, if high annual cash flow is important to you, in other words, money coming in every single year as high as possible, then cash on cash return is probably the metric that you most want to focus on. If you want a quick return of investment, IRR is probably the one you want to look at. If you want a balance of the cash flow and the equity side, the average annual return is a good one. And if you're just interested in overall growth of your wealth, regardless of the annual cash payments and such, then the equity multiple is probably the best. So it's really depending on, what your priorities are. So it's up to you. So what's best is really trying to aim to combine all four of these into one approach where you take everything into account is probably the best way. That'll give you the best picture of your investment. There are many other metrics that are out there that I haven't even touched on, but I wanted to keep this pretty high level and simple to start with, so you got to get a sense of what some of the biggies really are. So in the beginning of this video, I talked to you about this fifth important metric, quote unquote, that really sets apart real estate investing from everything else. And really, it's the tax benefits you get. Those are something that you just cannot get through stocks, through crypto, through anything else. The two big ways to take advantage of tax benefits here are really is depreciation, which is the big thing you get with real estate investing. And that depreciation can accumulate over time. And then at the end, say you go to sell the property or you're cashing out, and instead of paying the capital gains tax you would pay, and then depreciation recapture, you would potentially roll it into a different deal using something called a 1031 exchange. Now, this video is not about that detail, but there are strategies to do that, and it's and more strategies in regarding to taxes that I'm going to talk about in this channel. But this is the big thing that really sets real estate investing apart. So those are the metrics. Tax benefits are huge. This is really what it's all about in terms of a very high level bird's eye view of the metrics. So that's it. I hope you enjoyed this short video on the 4 primary metrics of multifamily real estate investing. Any comments, questions, feedback? Put your comments down below, and I'd love to see them. Take care and have a good day.